Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Good.
So
You want to start with the disclaimer?
Yep. Yeah, if you want to put it up. But while we're doing that, good morning, everyone. And before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Yep. I'm going to share my screen. If anyone's joined us for the first time, Will and I, we do this show in the morning to help answer any questions you may have about the Market Chameleon tools, the data or analytics. You could come on the show and ask your question live. We provide a link to Zoom on that live chat. So click on that link. When you get over to Zoom, click on raise your hand. Once we see that, we'll let you in. You could ask your question live and direct. If you prefer to type your question, you could type that question into the live chat on YouTube. Will's watching it. He'll read it back to me. While we're waiting for more people to join us and for questions to start coming in, we'll take a look at the pre-market report, see if we could get some insights on stocks that are trading in pre-market hours. Then I'll move on to take any questions we get. If we don't have any questions, I'm going to continue on our previous conversations we had about some of the Market Chameleon tools. We talked about risk management, valuation models. So maybe what I'll do is continue on that conversation until we get any questions. Okay, so for now, let's take a look at the pre-market report. And these are stocks that are trading in a pre-market hours. When I scroll down here, we get a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. When I come down here, I could see that there are 34 stocks right now that made our percentage gainers list and 117 on our decliners. So from this perspective right now, we're looking like we're setting up for a bearish bias at the open. I'm also going to slide up here, and we have these little boxes here with dates. Today, May 31st. This gives us a summary of what's going on in a pre-market versus, up volume versus down volume. And here we could see that 260 stocks so far that are trading in the pre-market hours are trading higher than yesterday's close. 460 are trading lower. If we take a look at the volume of shares, we do have 75 million shares trading higher, 50 million lower. So that's a little bit different here, but that could be lower price stocks that trade a lot. And as far as dollar value goes, we got $542 million worth of stock trading higher from previous day's close, 2.2 billion lower. So here still looks like a bearish bias at the open if we look at total market breadth. So let's take a look. When we look at this list down here, we see that there are small cap stocks in there. We have ETFs, leverage products. It could be a closed-end fund or a preferred stock. Any security that's traded on a major U.S. exchange, if it's trading in pre-market hours today and it meets our thresholds, it can make this list. So let's narrow down this list to a smaller group of stocks. And to do that, we could use the filters here above. And I'm going to use this one in ETF. When you click on it, you get a drop-down menu to choose from. There are a list of ETFs in there. We have some broad-based ETFs, sector ETFs. I'm going to choose this one, SPY. That's the S&P 500 ETF. And click on that. And when you do that, the list below gets filtered by stocks that are holdings in the ETF. So SPY, that's the S&P 500 ETF. We got the S&P 500 constituents here. And here we have 4 stocks that made our percentage gainers list and 26 on our decliners list. So in S&P 500 also looks like a more bearish bias at the open. So, well, I could stop here, take some questions. We had a couple minutes to let more people in. If there are questions, let me know. If not, maybe I'll just kind of move on, talk about some of the topics we were discussing last week.
Yeah, no questions have popped up yet, D.
Okay. So I'm going to bring up maybe my paint here. Let me see. I'll go to SPY. We could talk about, 2 things kind of came up. One was risk management. One was valuation models. So let's see if we could discuss both. And valuation models in finance, they're extremely important. Almost, any professional that I could think of always has their valuation models to see what do they think the price of a security theoretically is versus what the market prices are. And it gives you an idea, if there's a big divergence, is it signaling something? Either the markets are signaling something, it could be an opportunity, but they're extremely important. And some of the questions come up, well, what's the best valuation model, or what is the right number, or how much data use? And there's no exact answer to it. That's why, we build models and estimates, because if there was an exact model, everybody would be using it, and that you would see that everybody would see the same number on their screen. So I'll give you kind of, let's just paint a picture here. And let's just say, here's a circle, and we have a price here of a security, let's say a house, right? Everybody understands what a house is. I'm going to use a house as a security. And, we see the house, and we get a market price of the house, right? Market price, somebody is asking, let's just say it's $200,000. So now we're going to try to figure out, okay, is that a fair price? Is it a good deal? Is it a bad deal? Like, as a buyer of this house, or even as a seller, both parties really want to know, is this fair market? So then you have to come up with an estimate. And of course, I'm looking at it from a perspective, as, is it a reasonable financial investment, or is it sound? And some people, they'll buy houses because it's just one of a kind and they'll pay up. But let's just look at it from the perspective, is it like a reasonable price, where you'd get a mortgage, and is it the right price for that house in that area? But how do you know? And you could start running models on it, right? So let's say one model you could just look at, what is the average price of a similar house, right? And let's say you run this model and you do whatever by square foot, whatever, and you come up with, $185,000. That's the fair value, based on where the average of all these recent sales happen. Then you could have another model, right? And you could have a model where you're like, well, what if I'm looking at it as an investment and I need a 10% cap rate, right? 10% cap rate. And, based on, rent versus purchase price. And you run that model, and then you get a different value. All of a sudden, you get 210,000. Why is it doing that? Okay, so now you got two different models giving you two different answers. And you could see there are going to be assumptions in here too. Well, the assumption in 185 is that, all these houses were similar inside, the average is fair valued, that the market hasn't changed since then. It's pretty much the same. You're making a lot of assumptions that they all needed the same amount of work. So they're all essentially the same. In the cap rate, you're also making an assumption that you could get this rent, that you could lock it in, that you're not going to have other issues along the way. So all these models have to have an assumption, because you're building a model based on data and some reasonable assumptions that you're using. But you could keep going with it, right? We could say, like, well, what is the replacement cost? What if I had to build it myself, this 200,000, what is the cost of replacement, right? And let's say that comes out to 250 all of a sudden, but then you get a new house or whatever. Or you could even create a different model, and you could just forecast, could do a forecasting model. And what would a forecasting model look like? Well, forecasting, you could, forecast, you could do population growth, rent growth, maybe, low inventory, or are there more houses being built? All this stuff, you create a forecasting model, and you say, based on the demand versus supply pressure, based on, where you think rents are going to be going, based on like your forecast of that neighborhood, you come up with a new model, and that one says, 190,000. So all these are different approaches, right, to try to come up with, theoretical value. Let's call it theoretical value. Theo value. And all these have assumptions in them. These aren't, there's no way to get an exact number, because even cost of replacement, well, you're making that estimate until you actually build it and you go to Home Depot and lock in prices, or your contractor, like, you get all the permits. You don't know for sure what it's going to cost you until the end, right? Though that's an estimate. Prices could go up, they could go down. You could have unforeseen expenses in there. It takes you longer to build than you expected. Well, you're paying taxes and interest and all that. So all these are based on assumptions. There's no way around it. You can't get an exact number. That's why we do financial model, right? And which one is right? Well, now you got a different range of prices here. Which one do you use? That's the question that comes up. Well, that's where the trader comes in. You're looking at all of them, and you're taking all these ranges, and you have to come up with a decision, right? That's part of trading. That's the human touch, right? The computer can't do all that for you. And how reasonable are these assumptions? And of course, you're going to have, many more factors, right? That come into play, because taxes could change, things could change, the area could change, for better or worse. If you lose jobs, they go away, or more jobs come in, many other unforeseen factors in there. And these are things that are happening every day in the market, and not everybody agrees on the assumptions, right? That's why we have a market. If there was a model that everybody agreed on, that this is definitely, If everybody agreed on a coin flip, heads or tails, then there's no market for heads or tails coin, right? There's no stock market, heads or tails, because everybody agrees it's 50-50 heads or tails. But these are things that people disagree on because they have their own assumptions. They're putting in their own value on, what they're trying to do. And you're looking at these, creating these assumptions, not only for yourself, but what other people in the market might be looking at. And then that's a big, and even any of these, like I said, choosing just one, or just choosing one and going with one and ignoring the other ones means you just didn't take in all the other information or into consideration, right? So the more information you have, the better informed you are, the better your decisions. So when we look at theos, either we do a distribution of returns, we'll look at theos based on historical IVs. We have different theo models, and if the question comes, well, which one do you use, which one is the best, there's no such thing as that, which one do you use or which one's the best. You're looking at different scenarios that are giving you a different output and a different answer, right? So this answers this is the answer to, well, where have people been buying and selling, right? These are the average prices. This gives us an answer. Well, if I buy it and I rent it out, what is my return on my investment if I'm just going to do the carry trade, right? That's the answer to that. Well, what if I just ignore this house and just build my own with, and do it the way I want it with, my own, picking out all my own stuff? How much is it going to cost me? That's the answer to this. Well, what if I do a forecasting model and think of, take into consideration what I think is going to happen in the future based on my projections of, are more people going to come into this to this particular town because they're going to be more retirees, this is desirable, there's no more place to build, builders aren't starting any projects, the inventory is low. That will be the answer. So you could see that the models themselves usually start out with, what am I trying to answer using a particular type of data? And even these, they're no exact, right? They're no exact, you're doing estimates. But then you get a clearer picture for yourself. Well, what do they range from? In here, from 185, right? I get models to 250, depending on the model, right? How much weight do I want to give the model? Do I want to take all of them into consideration, take the average? Do I want to just stick with this one because it's the most relevant to me? These are all your decisions, because even if you stick to this one, right, at 210, and it might be worth to you 210, well, what are all the other, you want to look at, well, what are all the other people that could be looking at it? What do they think it is? Because you still don't want to, overpay. You're still trying to get a good deal, and so is the seller. So everybody else could be looking at these other competing variations of how to price this asset. Okay, so this goes to the question, what model do I look at? Pay attention to what is the data, what is the number. And in trading, when you're trading risk, there's no exact answer to that. You're just trying to use models and data to help you answer some questions to make more informed decisions. Okay. So hopefully, this helps answer that question. If there are no questions, I could move on to some risk management.
No, that's good. Actually,
Yeah.
Sarush just mentioned June 13th. I'm assuming he's talking about we have our IBKR webinar on June 13th, right?
Yeah, so we have another one, Interactive Brokers. Wait, is it June 3rd? Is it next Tuesday? Or June, or which
It's
Tuesday?
next Tuesday. Sarush, I'm assuming you're talking about the IBKR webinar. He texted that. Can't wait to see it. It is June. It's not next. It is the second Tuesday of every month, which is
Okay, so it's
13th.
okay,
So
okay,
it's
so
not next. It's not next Tuesday. It's
yeah, you're
two
right,
Tuesdays.
right, yep,
Yeah.
yep, so we'll be talking about that.
They're already promoting it. So
Oh, awesome. No, thank you for bringing it up.
yeah.
Definitely. And we'll talk about more models and what we're building, what we're trying to answer with models, but I think just getting the sense of, before you get into it, what are the expectations? Are you going to get this exact number where you're like, oh, 250 here, 200 there, it's definitely a buy? No, you have to take into consideration all these models. There are different competing models out there. What we try to do is we try to build these models first to answer ourselves questions and to get a view of what other people might be looking at that are participating in the market. Right?
Actually, Rob mentioned something this morning that he's noticed for a while. Is that, and Rob, correct me if what I say is wrong, but movement and particularly big moves in Bitcoin, tend to reflect in the market soon after. He was discussing,
and that's a good point, because with financial modeling of risk assets, the possibilities there are incredibly large, because we have so many different risk assets and inputs that we could use, just like Rob right now mentioned. Well, if all Bitcoin didn't exist for forever, and maybe the relationship between Bitcoin and other risk assets has started to correlate in a different way than it did years ago, right? And it's worth then looking and creating that model to monitor it and see how close is that relationship, how strong is that relationship. And if it is, you want it in front of you, because other people might be also looking at that, making decisions. And you want to know in the marketplace, what are other people looking at? How are they basing their decisions? Is there a strong relationship, a strong correlation between it? Is it a lag between the relationship? So you start developing a lot of theses, but you only develop those theses when you're deeply involved in trading, right? So just coming in your first day, I think some people want to come in their first day and understand everything, in a half hour, explain everything to me. Well, that's not possible. It's not rational. That means you're just not educated enough in risk assets to think that in a half hour you could just understand everything about financial markets, because they're very developed, and they're lots of variables and intricacies and rules and things in place that you'd have to understand. So there's no way anybody, I don't care who you are, if you've never dealt in financial markets, that you're going to come in and understand it in a half hour. It's impossible. Nobody's able to do that. You need to have be pretty involved in the stocks, options, whatever you're in, before you start really understanding and getting things. Let me see if we have 5 minutes. I don't know if I have enough time to go into some of the other questions we had about risk management, so I might save that for tomorrow. Will.
All right, perfect. Well, we've only got a couple minutes before the opening bell. Great job as always, Dima. Remember, those emails are going out to register for the IBKR webinar already. That's in 2 Tuesdays, the 13th. Thanks for reminding us of that, Sarush. Great job, D.
Right. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.